What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Michael, that background is really depressing right now.
I know. I've heard. We started this pod. I was on the road in the East Coast with the in-laws family, and so I was moving around. Got back to Texas, and I'm not a professional influencer like our buddies here on the pod. So my background is not up to snuff, but we're working on it. It's a progress. I
mean, I'm throwing rocks in a glass house right now. I'm on the back deck with a Fiat plastic deck divider behind me, so at least I got some trees right up here.
You have a nice mix of background, and you listen to, since you've been out on RHR, you hear seagulls, you hear sirens, cars, people honking, neighbors mowing. It's very diverse.
Yeah, we're gonna luck out today. It's a rainy day here at the Jersey Shore, and so there will be no advertising single prop planes flying over the beach. They're not going to waste those ad dollars. But as you may be able to hear, somebody decided to mow their lawn as soon as we hit record, and the weed whacker is out. But I'm not here to talk about backgrounds in the Jersey Shore. We're here to talk about Bitcoin. And we are joined again by Dylan LeClair. Dylan, welcome back to the show, sir.
Happy to be back, guys. I've been a fan of what you guys have been doing in the meantime. I think after episode 1. What is this episode? What number is this one?
9.
Nice.
You're almost in the double digits, guys. It's becoming a legitimate. But yeah, we got a lot of feedback from our first episode. We came out of the gate, guns ablazing. We were a little excited about launching the new show, and myself, Michael, and Jesse sort of hogged the mic, and people were like, "Hey, let Dylan talk more." And so, taking that feedback into mind, I think we start today by jumping into a piece that you wrote within the last week on disinflation and the current state of the economy. What's going on?
Yeah, sure. I guess so. I would preface it by saying, there's somewhat of kind of a fear mongering section of FinTwit that's disinflation, deflation, bust, this is the end state of things. Just to, for anyone that's not familiar with statistics, there still is inflation, right? There still is, the level of prices is obviously still rising. It's just rising less frequently at a slower rate of change. But I think people, with the CPI coming in, and we can debate whether CPI is a good gauge of inflation, but it's what we're working with. Came in at 3%, right? 12 months in a row of lower inflation. And the key thing that stuck with me was from that was while, the stock market was celebrating, S&P, NASDAQ melted into new highs, we're basically in a second tech bubble. That's, if you look at the top 7 stocks in the stock market, they're almost surpassing their 2021 bubble highs, $12 trillion market cap. So, the stock market's back, disinflation, inflation was transitory after all, but I think it misses the point a bit, at least temporarily in the interim. I still think a decade of higher inflation and financial repression is ahead, but in the short to medium term, I think the disinflation is the main thing to focus on, and here's why. It's because, we went through the fastest rate hike cycle ever, right? 500 bips of rate hikes in the span of 9, 12 months, something along those lines, in 2022. But it was masked by the high rate of inflation, right? So that tightening of monetary policy, if you just think of a real yield, right? And technically the bond market guys would say real rates are looking ahead, not looking behind. But if you just look at the Fed funds rate right now, it's 5%, inflation's 3%, right? So in the past 10 years post-great financial crisis, rates were 0, inflation was 2-something percent. Post-COVID, rates were 0 for a long time, massive QE. In 2021, inflation starts to fly, right? And everyone's saying it's not transitory. Obviously, this is here to stay. inflation gets up to 9%, 10% plus in the EU. The energy crisis of the Ukraine war kind of stoked the flames. But those rate hikes weren't really felt because inflation was still so high, right? So like there really wasn't tight monetary policy, right? Real yields, you could still borrow at a lower rate than inflation. That dynamic has flipped. And so I think if you just look at previous cycles, right, like the economic downturns, the kind of the bust phase of these short-term debt cycles we see, of these asset bubbles, they don't really happen until the Fed starts cutting rates. And why does the Fed cut rates, right? Because the economic cycle, economic activity, the economy is deteriorating really fast. And so they start to cut rates, and then you look at what happens to the S&P, you look at what happens to the labor market, the real economy. It doesn't actually bottom for a while. And it really, it's almost like looks like it's sparked by that first cut. So everybody's kind of like, disinflation is here, soft landing, everything's great. And the pessimistic side of me is I think there's a bit more nuance, and it's the fact that, we're seeing the labor market just start to turn. There's, a lot of research from, the banking sector says that default rates for retail and the real estate side of things is ticking up. Delinquencies across the board for all kinds of credit and financing. And, with this disinflation, rates are now positive for the first time since before the great financial crisis on a real basis. Real yields also, backwards looking and forwards looking are higher than they've been for most, for many investors' entire lifetime. For also, if you look at Bitcoin, for all of Bitcoin's existence. So that's not necessarily an absolute bearish thing. It's just a reality that we still have a whole lot of debt out there. Debt to GDP is still very high. Still, 120% at the federal level, and real rates are actually positive, at least forecasted to be, and, on a trailing basis. So I just think that, that's a transitory outcome, because real yields can't remain positive for long without things, without the wheels falling off. So it'll be really interesting. I think, the soft landing calls are premature, and we're going to, we're still not out of the woods yet. I think people think that, we did it. We engineered a soft landing. Powell and the inflationist transitory camp was right. We're so back. And I think that's, this thing is far from over. So that was a long form version of kind of the state of things and, what I was trying to get at with the disinflation post I put out. But yeah.
That, and it's so interesting because at this point I've spent a fair bit of time studying the 70s, a little bit the 40s to see what happened. But in the 70s, there were 3 waves of inflation, which meant there were 3 waves of disinflation along the way. And obviously, it kept coming back. It was not a problem that was solved as soon as it started to ebb away. Even thinking about 2008, Bear Stearns went under in March, and then it took until the fall for the other shoes to drop. It takes time for the bodies to show up, as the tide is going out. And right now we're seeing record bankruptcies. There's your indicator that things are not all well. And I keep biasing back to what Stan Druckenmiller has said of, this is a terrible environment to predict, first of all, the hardest he's ever seen. He's in the hard landing camp still, because the damage is done. The damage is done and is yet to show up fully.
Yeah, I think the labor market is key. If you look at the 70s, a lot of that, at least the first initial wave, was an energy crisis. And we saw somewhat to a similar extent in 2021 or 2022, the Ukraine war. Oil went to $130 a barrel. Natural gas was spiraling out of control. There was an energy crisis. And that faded away. And, actually, on a year over year basis, part of the reason why the CPI is so low is because, the energy inflation is actually deeply negative, at least in the trailing 12 months. So why is inflation so high? And it's the core basket, right? Which, I will say there is merit to saying core inflation, what is that? Oh, exclude food and energy costs. And some from the Bitcoin camp, including a little bit myself, will be that's the stupidest thing I've ever heard. Why would you exclude food and energy from an inflation gauge? And well, the reason is, at least from an economist standpoint, is that those baskets are very volatile. And if core inflation is just services, wages, right? So all that it's differentiating is core inflation is higher than the CPI, which means what? Well, this is a wage driven thing. So if you think back to I think 6 months ago, right? Late 2022, Powell's saying, yeah, we, in a Fed speak way, right, kind of all jargon, he's saying like we need unemployment to get to like 4.5%, which, employment at that time was like the unemployment rate was like 3.5%. So he's saying we need Americans out of the workforce. Well, why is he saying that? And he's saying that so that the labor market cools down and wage pressure goes away, right? So this is like, the kind of like messed up dial and kind of like Rube Goldberg machine economy that we live in, where, central bank bosses are trying to, play God with the economy. But this is the state of things, right? So I think they're going to be effective. I think they keep things tight until we start to see inflation cool down, because of it's already cooled down, but the labor market, I think, cracks a bit. If you just look at like excess savings, right? They pumped everybody's with money in COVID. The bottom two quintiles, and this is part of the post I shared, the bottom two quintiles of the U.S. economy from a savings perspective has already ran out of money. And soon that third, that 40 to 60% quintile is also going to be out of money. It's really just the richest 20% of Americans that have all the excess cash, and the rest are now starting to rely on credit, right? So this is where, especially with unemployment ticking up, this is where it gets a bit ugly. People have been kind of coaxed to think that, recessions don't occur anymore. This like post QE era is everything is fine and golden, and we don't see downturns anymore. And I think that's a naive perspective. So it'll be really interesting. Partially, I think it'll be interesting because we might see this downturn, whether it's equity market related or just the real economy and or both, occur somewhat at the same time as Bitcoin halves. And the response to these downturns, to these deteriorations in economic data, also asset crashes, whether it's commercial real estate or equities or whatever it is, bonds, is one and the same. It's always they're going to pump this thing back full of money. And I think that's where like the timeline gets really, really, really interesting, is like we might see, Fed cuts and or, some form of stimulative effect from Congress, fiscal spending, maybe not with the presidential elections, but after that, right, somewhat in line with the Bitcoin halving. And that's like a pretty exciting timeline for me.
Yeah, and I wonder if we even have that much time. Logan, you can pull up the picture I just put in our Slack channel. We discussed this yesterday on Rabbit Hole Recap, but Peter St. Onge wrote a really good piece on his Substack about the commercial real estate market, and I'm becoming more convinced that outside of the labor market, this is going to be one of the bigger shoes to drop. And if you just look at these numbers, they're pretty startling. So for anybody listening at home and not seeing what's up on the screen, here's a section of one of Peter St. Onge's recent Substacks. As the money dries up, commercial real estate prices are now plunging, with institutional quality offices losing 27% in the past year, apartment buildings down 21%, and malls down 18%. And this is the most startling stat in this piece, and it makes sense if you consider the state of San Francisco and the squalor that has found itself in. San Francisco's office vacancy rate is now at 32.7%. Pre-pandemic, it was 4%. A recent study from Berkeley found cell phone traffic is actually down 70% in the city compared to pre-pandemic. And so in the context of commercial real estate, obviously it will likely affect some cities more than others, but San Francisco being one of the most popular commercial real estate cities in the world pre-pandemic, it seems like there's going to be massive losses in that market coming to bear soon.
Got any CLOs?
Yeah, it's a human story for me, because I lived in San Francisco until 2018, and had a bunch of friends up there after school, and they're all gone now. Like there's one or two people in the Bay Area still. Everybody else has left. It's been a general exodus from the city in general, but like we all used to go downtown to work every day, like my whole cohort, and none of us are there anymore.
Yeah, the commercial real estate thing, but I think particularly like not even just that, but just like what COVID did to the like perception of like office work and the kind of like the information economy, I think is a one-way shift. And you're seeing like a lot of these guys that are like coincidentally like commercial real estate holders, or have some stake in like investment firms or private equity firms, and they're like, we're like, yeah, remote work, I think is going to transition back to going into the office. And it's like, they're talking their own book, obviously. But that COVID was like, I think a massive accelerator to a lot of this stuff. And everybody kind of realizes like, no, I don't need to commute an hour and a half to go sit in a desk when I can just do this from my house. Like, obviously not.
And to paint a little bit more of a picture about why this is a kind of a ticking time bomb, a lot of these assets, these office buildings, basically like 90% of them, I believe is a stat at this point, are on interest-only loans. So these are mortgages effectively, where the owner is only paying interest. They're not paying down their mortgage, which is just a riskier form of loan, and means that any drawdown in valuations, exposes them more quickly and more dramatically. And so that's happening at the same time that there's a huge drop in demand for these spaces. So at what point in time does that shoe drop? And then who does that impact? Because for most of these assets, these live on the books of regional banks. They're actually the leading lenders for commercial real estate, because it's historically been kind of a niche they can have some expertise in. They know the area, this is their region. And so they've served these markets in that way. So what happens then? Do we have the next wave of the banking crisis? Because suddenly commercial real estate investors are going bankrupt, and that hits the books of the regional banks that provided those loans, and suddenly they're underwater, and a lot of them. And now you're the Fed. What do? Do you just let them go out of business because it's capitalism and that's what should happen? Well, that's not what happened in the spring when we had the banking crisis, and they stepped in to create the BTFP and calm the panic and backstop these underwater assets. So when does that shoe drop is really, I think, the question at this point for me, rather than is there a problem? I think it's when does that manifest?
What I think? I think that the BTFP, like you mentioned, I think that is going to be an indefinite program. If you just look at the mechanics of it, it's like, okay, treasury bonds the risk-free asset, treasury bonds, long-dated treasuries, that everybody just said was cash equivalent essentially. And they just locked in for 30 years because interest rates were zero, and that was the only yield they could get. Well, yeah, actually they saw a 20, 25, 30% drawdown. And so BTFP comes in and says, oh, just for 1 year, a special program, you can take this collateral and you can mark it at par. And it's not just treasuries, it's agency debt and mortgage-backed securities too. So I think they come in, they're going to have some more word salad. Maybe it's the same, acronym facility, maybe it's a different one. But if there is any crisis, maybe even if there's not a crisis, it's just, they wait the full year, BTFP continues, and they just say, oh, no, we're going to continue on with this program indefinitely in some kind of press release that they don't even really project publicly that loudly. They're going to be like, yeah, we'll continue this thing. And any losses that are incurred in the commercial real estate, like obviously if you default, you don't own the asset anymore, but what's the, the chain effect? What's the kind of the counterparty risk? Well, it's just the Fed's balance sheet, and they don't care because, they're not a real actually asset allocator. They just print money. Any losses, they just, mark down. Like Jesse had a really good post about, that picture of the Fed's basically P&L, right? They hold all these long dated bonds that are giving them 1%, 2%, 3%. Meanwhile, they're paying 5% Fed funds, 5% on the reverse repo. So they have losses every single day, and they're not recording those losses. It's just like a deferred asset or deferred liability or whatever they call it. So I think that's the same thing they're going to do with commercial real estate, mortgage-backed securities. They're all this pile of crap assets they're going to be securitized. The Fed's going to buy them, and they're just never going to actually mark down the losses, or maybe marginally. But it's just the Fed's just going to eat it, and they're just going to socialize the losses once again. No investment banker, no maybe a few of them isolated, but there's not going to be some mass banking crisis where all of these, the whole banking system fails, or they sustain massive losses because they made bad investments. The Fed's just going to make them whole, right? That's essentially what the BTFP already is. It's oh, it's only 1 year, don't worry about it. But here's this asset that's 70 cents, 65 cents on the dollar. You get to post it as collateral at par, right? And also any institution using this, domestic and international, we're not going to reveal your name, right? Like what is this? And no one even understands the mechanics of this, but it was a bailout, right? Like, can I pledge my Bitcoin as collateral at $69,000 value? No, duh, right? Like that doesn't compute. But they play at a different set of rules, obviously.
Yeah, and Logan, if you could pull up Jesse's tweet, really visualizing the amount of losses that the Fed is holding on their balance sheet right now. It's pretty astonishing to see this chart.
Yeah, I came across this chart on Twitter. For people not watching, it's kind of a straight line at like basically zero, but in the positive. This is the Fed's profits. And remittances due to the Treasury is the term that they use. But when you dig into it, what that means is actually profits that the Fed is generating. But then in the last 6 months, really 9 months, it has fallen off a cliff, like dramatically. It looks like a depeg of a stable coin. And the accounting on this is comical. Dylan nailed it that, this remittances due to the Treasury is Fed profits that they feed back to the U.S. Treasury for use in general spending. So that's the agreement for the Fed and their operating mandate. Any profits get used for general spending elsewhere. But if they have losses, those losses just sit on the Fed's balance sheet, which is central bank balance sheet expansion, which is this cardinal sin that we're all shouting from the rooftops about, like, this is a problem. We got to watch out for this. This is Japanification. So when you hear that term, that means the central bank stepping in to buy all that distressed assets because there's no other buyer. And okay, great, that's fine. But what does that mean? Well, it means inflation. It means that you're growing the monetary base because the Fed is writing blank checks. And that manifests somewhere as inflation. So you're paying for it in this indirect tax of inflation, ultimately. And that process has now begun. And I think Dylan's right that, these underwater securities, these U.S. Treasuries that were, 1% yield, we're not going to go back to that. So they're going to be underwater indefinitely. And in that scenario, they're just going to have to roll this program and keep expanding this program as other shoes drop, like commercial real estate. And they have to step in and create a new acronym facility for regional banks that have commercial real estate exposure. And that Japanification process just will snowball and continue. These are layers that will be added over time. And the net of it is balance sheet expansion, creating inflation, and the overall deterioration of our fiscal system.
Listening, as we walk through this, it's like the stuff we're talking about has been talked about, all year. We knew real estate, COVID, it was going to change its trajectory, and we're breaking down like how after tits up everything goes. But it made me realize this is why there's so much moral hazard baked into. There's moral hazard baked in the products because we know real estate, we know what happens to commercial real estate, but we're not necessarily concerned because we know some form of BTFP. Pensions also have large exposure to commercial real estate. They owe, capital to people retired. So that's going to have to be made whole by somebody. But I think this is what makes it so hard to explain Bitcoin, especially when it comes to the financial products and how you actually secure, because most people inherently have in their mind, like when they go and secure assets, it's like, yeah, I know there's maybe something that might happen, but it'll be figured out. We'll get it done with. Like, they would never let me starve. Like, we're in the United States. There's all these like things that the moral hazards baked into financial products in the US. And so like what we talk about, we all know, and I think intuitively more and more people are waking up, but it's similar to like what happened with COVID in the sense that most people were like, like they could never really put us in a box. They could really never shut us down. And then it happened. And I think some people woke up, but we still have so many people asleep that like people inherently know there's a lot wrong, but at the same time, I think just bailout after bailout, decade after decade, it's just baked into the psyche that it can't really actually spin out of control. And I think that ties into just why it's so hard with this new asset, like in how you secure it and how you deal with it. Because it's like, I'm not worried about it. It'll be figured out. But every year and then every decade in the Bitcoin space, we just realize that's actually not how it works. And a bunch of people end up with holding zeros where they thought they were holding, Bitcoin.
Yeah. And Jesse and Dylan both reference Fed speak, the Fed trying to posture a particular way to exude a confidence on the markets. And Jesse, you just fell for some Fed speak. You said regional banks, they'll have to bail out. And that's one thing I think we do need to make clear with what happened earlier this year with Signature, First Republic, Silvergate, and those three banks predominantly. It was marketed as a regional banking crisis, but we cannot forget that those were three of the five largest banking failures in U.S. history. Like they're trying to say, oh, no, it's just the regional banks. Yes, it's not the J.P. Morgans, the Wells Fargos of the world quite yet, but labeling those banks as regional banks to exude a sort of contained crisis in a smaller segment of the banking sector is some Fed speak that people have fallen for.
Yeah, and I'd go even as far as saying inflation. There's no inflation, or it's reduced to 3% is another component of Fed speak. It feels like there's a tale of two worlds, like of just the U.S. when you think about coastal, kind of like you turn on CNN and what's actually happening in the world, and there's a tale of two economies when you hear of like the Wall Street top 10 to 20% and what actually people are feeling. And there's completely two different things. Like Marty posted, or I don't know if you posted it, or you posted on Twitter. I don't think we showed it on the show, where the haircut, the barber up in upstate New York basically had been trying to hold off as long as possible to increase prices. And like anecdotally, where I live, there's a lady that like delivers food as part of one of these services, and she was just sharing how she's seen like every quarter in the past 2 years how her number of like clients just start to reduce in the amount of groceries they're buying, where she used to have a whole like ultimately like a book of business that's just been like cut down 75% because people don't have the disposable income to either buy more groceries or have to use those services. And so this is like across the whole economy where people are getting like kneecapped. And, we talked about credit and debt and credit cards and all the things associated. But it's not as cut and dry, I think. And I think, Dylan, you talked about it where there's like core and CPI, but in reality, they're both like tied in together. It's kind of like the Fed and the economists that decide to like start to pull out and the different levers they want to describe how they are separate, but in reality, like they both feed directly into disposable income and how dollars are used.
Yeah. And this is actually, well, to tie back to Dylan, I want to get your thoughts on this, like talking about the Fed trying to induce a soft landing, really targeting the labor market and unemployment. Logan, if you could pull up the participation rate chart, the screenshot I shared in Slack, one thing I'm very interested to see is, does the participation rate, like obviously we're coming off the back end of the economic lockdowns and we've had a lot of layoffs in the tech sector and there are a lot of jobs available, but they're typically in the service sector. And so this is one thing I wonder, the participation rate specifically, does it throw a wrench in the Fed's ability to create a soft landing? Because as people remain unemployed for longer and fall out of the unemployment calculation and fall into the falling participation rate, like does that really prevent the Fed from actually reaching that target because so many people are falling out of the denominator? If you see on the right side of this chart, the participation rate, after increasing pretty significantly after the COVID lockdowns, never reached the point where it was right before the lockdowns, but it seems to be flatlining and could be going lower moving forward.
Yeah, I have a lot of interesting thoughts about the participation rate, and like some of them aren't too nuanced. But I think there's like a huge bifurcation in the labor market that just like, unemployment rate or like even labor participation rate doesn't capture. And like some of this is anecdotal, but like, especially in 2022 when, all these tech stocks got decimated and, the VC bubble somewhat burst, like AI seems to be reinvigorating that, kind of like micro bubble in a way. But, I can just tell, like, I would have graduated college a couple months ago, talking to all my friends. A lot of these people are applying, close friends are applying to like, good jobs. They have great degrees, got, good resumes, and none of them can get like, basic entry level jobs and, into like the remote workforce, right? Where as 2 years ago, these people would have been making six figures off the bat at a tech firm in San Francisco, like no problem with stock options, right? And meanwhile, like if you look at just like the blue collar sector, like, my dad he has a small family business, like does some electrical work. The median age for those blue collar guys is like 56, 57 years old. And there's no one coming down the pipe. Right. So like, and at the same time you have like AI that's like apps, and the AI memes are kind of outrageous. Like AI is going to, bring a utopia, or it's going to like, displace 100 billion jobs. It's like, okay, let's settle down a bit, but it is definitely going to displace a lot of entry level, like email type jobs, right? Like you just see it, like Microsoft record profit, they laid off like 1,000 workers or a couple thousand. I don't remember the exact number. And I think this is a trend that will continue. Right. And so, yeah, like, is the unemployment rate going to go up a bit, while we're in this tightening cycle? Probably. I don't really know the direction of the labor force participation rate, but I do know there's a massive mismatch in, the type of jobs that, especially like for America, the world reserve currency, we kind of have this artificially strong dollar, right? Like the coastal elites for the past 40 years, 20 years in particular, have really benefited. Silicon Valley, Wall Street, DC have done great. Meanwhile, like, the Rust Belt, American manufacturing gets absolutely hollowed out. And I think maybe that's not reversing, but, the whole COVID thing, working remote, and also like AI has kind of opened up this, it kind of was like the genie's not maybe fully out of the bottle yet, but I think people are figuring out that, work is available globally. Anybody can do it. And even AI can do it. A lot of these like kind of really high paying, like entry starter level jobs. And so I think there's a mismatch in terms of like, especially in the American labor market, where it's going to take a while to figure out. And also like from a demographic perspective, the boomers, a lot of these people that are working these like blue collar jobs are all retiring. Right. So like, I think that's something that can, take a while to shake out, and also can kind of throw a wrench through a lot of these like, employment models per se, right? Because like there's a lot of people looking for jobs, but like, there's not a lot of people that are like looking to be a plumber, right? There's a lot of people that are looking to be a consultant at Deloitte. And that's like, those aren't the same, those aren't the, one and the same in the labor market, but they are in the data.
Yeah. That's something I think about a lot. Like there's going to be, you hit the nail on the head. Like that's going to be the next decade. We talk about like hard assets, hard skills are going to be hot commodities in being able to actually produce value in like meat space. And like we talk about like opportunity cost or cost of capital. And you think about like I was at Google and WeWork, and I just always remember, there was I never spent more than 3 years at any of the firms. And part of it was like going there and it was fun, but then you realize like these people aren't working, like what are they doing? And it was just, there was this baking in of the models of like growth and hiring. And we saw this at Twitter when Musk came in and basically cut, 50% and nothing stopped working, where I think because we had been in a bull market for 10 plus years, that it hadn't really been understood or felt, one, that you can have a more efficient way to grow a company, but two, that the market could churn like this. And the fact that it's happened and now it's in the psyche, whenever it does and interest rates start to lower, it's still not going to come back fully where people just say, oh yeah, let's just hire all these people and have them do nothing. And so there's going to be a lot of basically stock in people that, to your point, went to school to get out and be, whether it's consulting or work at Google, that are going to have to go into the real world and work. And I think a lot of those people have been sitting on the sidelines. They've even historically been sitting on the sidelines, but I think they also are now waiting for a market to come back, or to your friends, kind of like trying to see what's out there versus just getting in. So it's going to be a very crazy decade, I think, for folks that went to school because they were told to, and they're in $100,000 in debt and now have to figure out how to like produce value in the real world. And that's the only like value right now that's like looking for it to pay.
Yeah. And to tie a couple of these themes together, I have an interesting anecdote. I ran into an old like middle school buddy from my hometown. He was down the shore, ran into him on the beach, and we got a conversation started. And he's actually one of the few smart individuals in our generation who went and started his own plumbing business. But to tie this into like the real estate thing, like his business is crushing it, but he was telling me he's noticed in the last few months he's going to make small repairs to people's houses, and he's showing them like his cost and what their bills are, and they're like looking at it in shock, and they're actually a bit panicked because a number of his clients have told him like, yeah, during COVID I took out a HELOC on my house and since interest rates have gone up, like my monthly mortgage payments have gone up significantly. Like I don't think I can afford to actually make this repair. And so just another anecdote out there tying it back to the real estate market, particularly, I think, and we're from like a small, humble blue collar town. And there's a lot of people who made those decisions during the COVID lockdowns to take out equity loans from their houses that are sitting in precarious situations right now.
Yep. The amortization schedule and like the calculation with interest rates from, 2 and some change percent to like 6.5%, 7.5% is absolutely mind blowing. I saw some posts on Twitter. It was like people on Reddit being like they didn't actually look into the math, and they bought a house and they were like, why is 90% of my payment in the first year going to interest? And it's like, well, that's how the math works, man. You're paying $1 million for a $400,000 house. That's the reality of a 7% interest rate. So, it's not an immediate thing, but like, no millennial can afford that. The average net worth is negative, right? Now, never mind the Zoomers. Like, there's just no way. They have unsecured student loan debt in 6 figures. You're not buying a house that costs, X amount of your average income. It's just not realistic. So I think there has to be some equilibrium felt there. I think a lot of the boomers, maybe not this year, but a lot of the boomers over the next, maybe 5-10 years are going to go to liquidate their home and realize that, the listing price that they thought that they would have, that clearing exchange rate's actually a lot lower because no one can afford it, right? Like, oh, you want to sell that second home you have? Well, that market for buyers really doesn't have any money or not enough of it. So maybe houses continue to go up in nominal terms, but like in real terms, the housing market was fueled by interest rates going lower for 40 years straight, right? Like a lot of people thought they were genius for just levering up and, house hacking or real estate hacking. And it was really just a leverage game with cost of capital going lower forever. And that reversed. And it's like almost like that kind of like Wile E. Coyote meme where like they run off the cliff, but like gravity hasn't been felt yet. Not like saying like, a great financial crisis, oh wait, it's going to happen again. The real estate market's doomed, but the valuations out there, it's not really, it's not really supportive for new buyers. Let's just say that.
Yeah, this what makes it so precarious, and like the gradually and suddenly meme is generally real because I was on a conversation earlier, and anecdotally, one of the largest REITs in the Middle East for real estate was talking about the guy had been like the family office sphere between London and like Dubai. And he was saying that his friends is kind of like the proxy for sharing the sentiment in the market, and had reached out saying, looking at the space, looking at Bitcoin, waiting for BlackRock to step in. And we were joking around, and we've talked about this before, but it's just like, if you think about it, like real estate is just a shitty form of Bitcoin, right? It's like illiquid, it's scarce, but it has a similar profile and why it's had some monetization around it. But as people wake up, it's like the first people through the door are going to probably make out okay, but then the door is only so wide. And so you have everybody trying to get out of these illiquid assets, and we're now in the context of real estate. And so I think that's how it ends up, where like, you mentioned leverage, like all the, whether it's Big Short and it's the strippers with the multiple houses, or it was, basically the last trade the past 2 years and all the Airbnb leverage and the 10 to 30 houses, that everybody's going to be left holding this bag at some point. When that happens, there's only so many people like to be able to move out of it into Bitcoin before kind of the mismatch in like what the price of the house is versus like where they can purchase a Bitcoin at.
Yeah. And I mean, I do think we have to pay homage to the forgotten generation, Gen X. I mean, we're talking about millennials not having enough money to buy these houses, but right after the boomers finish retiring, we're going to get this generation, Generation X, setting up to retire, and those born in 67, which I think is the front end of Generation X. I mean, they'll be retiring 10 years from now. And if you look at this chart, it was shared in Zero Hedge earlier this week, like the median Gen Xer doesn't have more than $40,000 saved up for retirement, which is insane. Like, and they've got 10 years to build that nest egg if they hope to be able to retire in any sense. And so this isn't a problem. I think it's a more immediate problem than just defining it as a millennial problem. The Gen Xers Obviously not as large as the boomers from a demographics perspective, but they're in a terrible position as well.
Insane. That's an insane just graphic. It's like median savings.
Logan, can you throw out the one I just put in the chat? Yeah. So this is a trend that's been happening basically. Like this chart, for people who can't see it, it shows the wealth, the percentage of the wealth owned by each generation as they age at that point in time. So the baby boomers is kind of up and to the right. They were accumulating wealth as they got older. Generation X has had half the slope that the baby boomers had, which is to say they are accumulating half the percentage of the wealth as time goes on, as they progress through their lives. And the millennials are half of that. So, even though we haven't gotten as far into life as Gen X or the baby boomers, we are on track to achieve much less wealth than either Gen X and, like 4 times less than the baby boomers. So, and if you were to put the next generation on this chart, it would probably be the same story again, a diminishing portion of the world's wealth accumulation over time, because the circumstances are just so much harder for younger people. And like Dylan, I wanted to ask earlier, what's the sentiment for like your friend group about, like the prospect of how you as a generation are likely to do in terms of accumulating wealth or like being able to buy a house? Like, what's that like in your friend group?
I mean, there's probably a small part of that friend group that's very much orange pilled, but that's obviously not the average perception or thinking. So a small number of them have been buying and holding some Bitcoin, but I think for the most part, the average or maybe median Gen Z Zoomer doesn't actually think about any of this at all. It's kind of just like live life in your 20s, and then like kind of a cold hard dose of reality. As you get older and still have that student debt, and like there's no one really is looking to accumulate wealth, build a family, like the kind of like the American nuclear family traditions that many like think of in terms of like the ideal. Maybe it's not thought of as ideal anymore, but like I think that's not the reality for the average for the average American Gen Z. It's just like kind of live it up. We'll figure it out. Like, F it, we ball. And, there's not much long-term thinking there. Unfortunately.
Yeah. For our generation, we had the YOLO era of cringy, nihilism in the moment. And I feel like at some point that has to crest and recede. And I think that Bitcoin is the reason why that happens, because without hope for building a better financial future by saving and accumulating wealth, then you're going to live in the moment because there's no incentive to save. And so Bitcoin brings back that incentive. And I think I see it as the most likely thing to turn the tide ultimately in terms of shifting our country and the world back to the incentives of building a life and saving for the future on an individual basis and an institutional basis as well.
And I think Gen Z is at a disadvantage to really wrap their heads around this too. I mean, as millennials, I'm 32. I was a senior in high school when 2008 happened. And that was obviously the largest financial crisis in my life up to that point. And we watched at a very young age the banks get bailed out, TARP get passed, and then QE happened. And as a young 18-year-old, that radicalized me. And I think this time around for Gen Z, I guess their baby financial crisis was COVID and the lockdowns, and they saw markets tank. But on the back end of that, it was a different type of stimulus, which was direct deposits into bank accounts. And so they probably have this false sense of security that if financial crises happen in the future, the government's going to be there. They're going to bail out the banks, but they're also going to bail out individual Americans. They'll start airdropping money into our bank accounts like they did post-COVID, not internalizing the destructive nature that has on the value of your currency and your purchasing power over time. And so there may be a false sense of security sitting within the generation of Zoomers that just went through the COVID crisis.
Yeah, well, I'll take my $2,000 check. Meanwhile, businesses get, loans that are granted away for hundreds of thousands of dollars. Like, there is really no understanding of that. It's pretty sad. One thing I will say, when you were showing the graphic of Gen X median and mean net worth, something really struck me, and it was that, and I'm not sure exactly how that was calculated, but I would bet, and I could be totally wrong here, but I would bet that in those statistics, it accounts for like 401ks and pensions or whatever else. And the funny thing, or maybe not funny, but kind of sad thing, is that it's, that is not savings, right? It's just passive indexation into a broad basket of, equities and bond securities. And like, oh, so, you're just passively buying tech at 30x multiples, right? Like after they've gone up, 20x over the past 2 decades, right? Like Apple's gone up 30% a year for the last 20 years, right? And so now you're just like DCAing into like a mega corp that, BlackRock and Vanguard are going to have, like, that are going to own the shares, and you'll get your ETF, and that's savings now. Like that's equivalent to savings. Is just like, oh yeah, we'll have some financial advisor DCA you into equity indices, no matter the price. And that's just like considered normal. That's actually considered a prudent decision because the money's bad. The money doesn't work. And now, like, for the past 20 years, bonds haven't even been a valuable form of investment with no yield. That's changing, at least temporarily, but like savings isn't actually a concept that's understood at all because there's been no incentive to understand it. In the 80s, it was like different, right? Or like, there was an interest rate. Now it's like, who's going to say, no one saves in a checking or savings account. Anybody that does understand like savings is like, oh, I'll trade futures on Robinhood. It's like, no, like that, there's the whole perception of like wealth accumulation has been distorted, and particularly like post COVID for anybody that's kind of like new to the game. But, that's not savings like that. That's just like, we're just going to along for the ride, and people have been rewarded for it, right? It's been right because that's been the direction, has been up because of the stimulus, because everybody's passively indexing into these things. But like stonks don't go up forever, right? Like this is, people like Americans especially think that this is a reality. It's like all you have to do is look to Europe. You have to look to any really emerging market to know that actually, no, stocks don't only go up forever. And at some point there's going to be, a point of reckoning. I'm not saying it happens a cycle or whatever, right? But like, the real estate market, the stock market, the bond market kind of already had its moment topping in 2020, and then it went down 30%, and everybody was like, whoa, what is happening? But like, this is what you get. People aren't investing based on like the quality of a company or its balance sheet or its discounted cash flows. People are passively just chucking money at a basket of companies at any price. And it's leading to these like, gross distortions that nobody really knows the long-term impacts of until, we run into a, crisis, and then things are like, panic mode. And so that's just like something I think a lot of people see, like, can't see the forest for the trees. It's like, this is a warped, grotesque kind of monstrosity of an economy that, fiat has built over the last, a long time, the last 50 years, 40 years in particular. And we're just kind of like on this train that's headed off the tracks on a long time frame, and everybody's just kind of docile and okay with it. And like without Bitcoin, like we wouldn't have, anything to like protest that. We wouldn't have anything to like opt out of that system other than like, vote harder, which is like, what does that lead to? So like, it's a pessimistic world if you don't have an optionality or you don't have a choice. But like, thankfully we have a choice, and we're all voting with our capital to opt into that world. But a lot of people they think of the Bitcoin thing as just like, some man caps and some weirdos and some laser eyed guys on Twitter. It's like, no, like actually we see the world for what it is. It's actually not how it should be. If you just kind of peel back the onion, it logically makes no sense that you save in a basket of equities, but like, oh yeah, they only go up, and they go up 10% a year. Like you ever see like all over like TikTok, which is like Gen Z financial advice. People are like, oh yeah, just, if you just passively invest for 50 years, you'll have $1 million by retirement. And it's like, and people believe that. People are like, oh yeah, like that's how I get rich. It's just like, punt money into stocks and it only goes up. And it's just like, these preconceived notions are totally wrong. And at some point, like it's going to lead to a lot of people getting hurt. And at some point, that's going to be the case for like people that have been doing this for a long time, the pensioners, right? Like the people that think they have money that's not there. Marty, you just tweeted about it. Like, it's a sad reality. And without Bitcoin, there wouldn't be much hope.
Yeah, you hit the nail. I mean, it really is sad. And what's crazy is everything you just described is really so like obvious and conservative. If you think about, we go back 50 or 100 years, if we switch Bitcoin for gold or savings or getting married and start producing value at the age of 18, like these are all just like concepts that existed for thousands of years in between, like propaganda, societal change, and all the things that go along with it. What you just described, to the majority of individuals, would say you're insane, you're nuts. Like I even have like, you know, family members are like, oh yeah, like, you know, they still find out like wife has a 401k that's hanging. I'm like, convert it to Bitcoin. She's like, no, we got to like, just be careful. Just because in her head, it's like, it's a 401k. It's like my old account. It has to be safe. Like just in case that Bitcoin thing doesn't work out. And it's just sad. Like that it's like the narrative and the things that society, like everybody, whether it's because it's work that's required or just going against a narrative that like, they just accept. All it takes is looking just right behind the curtains to see everything you just described, Dylan. And it really is sad because it's just like right there. All you have to do is just like peek behind it and realize that everything that's been explained or told, or all the debt and all the things that you've learned, are not actually what they seem to be. And then you're just ready to like understand what's happening here. And you can take that different position of understanding, okay, well, I can accumulate, I can have a plan to raise a family, have a child, retire, start the business. But instead it's just like going further and further out the risk curve. I was at the store a couple of weeks back, and I don't know how Bitcoin came up with the checker, but then the bagger was like, hey, I'm curious, like, what is your thought about Bitcoin? He's like, oh man, that shit's crazy. He's like, you know, crypto, like I know you can make some money, but you can lose it all. And that's like the perception of the market. It's just like, oh, well, I'll play with crypto, but I know I can lose it all, but maybe I can make it all back. It's similar as a lottery ticket. So there's still so much education and like learn and just, education on this part and within society to get that intolerant minority to the place where it's like, okay, this is the thing that I can actually hold my value in to, you know, increase purchasing power and actually have a better life for like myself and family.
Yeah. And I listened to a podcast earlier this week. I highly recommend anybody listening, go listen to this episode of Invest Like the Best. Patrick O'Shaughnessy had David Einhorn on recently, and he basically went on an hour-long diatribe of how value investing is completely dead right now, just because of the role of passive investing and people just DCAing in the stocks, the way Dylan described. Like, as somebody who made their whole career around value investing, he's essentially tapped out and saying, like, yeah, I don't think there's room for value investors right now because the market is so insane.
Yeah, I mean, you're fighting a 10,000-pound gorilla, right? Like, oh, this thing is undervalued or overvalued, right? Like, oh, I don't think NVIDIA should be worth, 400 times revenue, or, I just made that up off the top of my head. But like, it logically doesn't really make much sense, right? But like, no, you're fighting billions and billions and billions of dollars of indiscriminate flows. And actually the bigger they get, the more index weight they have, right? Like, oh, Tesla, worth, 2x more than every single automotive company in the world combined. Like, that doesn't make sense. Like at the peak of the 2021 bubble, right? But like, just like throw some call option gamblers and throw some ETF index flows and throw a couple leverage ETFs, and Tesla can be whatever you want it to be, right? Like that's the state of things, and it's really it is what it is. But like that's not like that. People think of that as like investing. It's not, right? Like it's not investing. It's somewhat of a casino. This is a little bit of like a tangential point, but growing up, like where I grew up, where I went to school, very, very leftist progressive state. And, once I kind of got my political bearings, I was like, almost like repulsed by it. I'm like, how could they think this? And then as I like matured a bit in my, my own understanding of how it all works, I sympathized with them. I was like, no, I get it. Actually, I get why these people are, protesting and saying, eat the rich. Like, not that I disagree with it. And I think that, they lack an understanding and a bit of a nuance of like how this all occurred. But like, yeah, like why should that person that literally did nothing except just leverage up his real estate holdings for 40 years be on his third yacht and have 4 vacation homes? Like, wow, did they work harder than me? Right. And like, that's where we are. That's why the boomer wealth disparity is so disproportionate. Like, it's not their fault. I'm not, I don't hate someone for being rich. And I don't think anybody should. They played the game, they played it right. But like, the fact that there is a game to play and to almost like, a rigged game, right? And the fact that 90% of people, 95% of people don't even understand that there's a game being played is the problem. But yeah, it's led to these gross distortions. It's led to the greatest wealth disparity ever. And we can see that these things lead to, oftentimes very, very polarized, polarized populace, polarized political discourse. So does it make sense that, there's Bernie has supporters and AOC and those type of politicians have supporters on the left? Yeah, of course. That makes a total sense. And I think, unfortunately, the reality is that, as we go into the, late 2020s, early 2030s, and there is this massive wealth disparity still, and, the consequences of fiat monetary policy continue to take course, there's going to be a lot of people that are very, very angry. And there's going to be a lot, the second and third order effects of that from a political standpoint are going to be scary for people that actually understand where it leads and what it can lead to. So, I don't really have a political solution to it other than opt out and vote with my capital for a better world. But people that think that we're just going to vote harder to get out of this it's naive. And it, lacks a bit of understanding to how we got here.
Yeah. Vote harder with your value. That's the only real thing that you can do, I think.
That's the only real vote you have, right? At the end of the day, particularly in America in 2023, if you understand the political landscape and the way RFK has a lot of support right now. It's likely that the DNC is going to box him out of being able to actually run in this election because they have their guy and they're just going to push him forward, whether or not he can speak a full sentence or not. They want to hold the power they have, and they're going to use everything at their disposal to ensure that they keep that power. And there's nothing you can do. I know this is controversial and people really don't like to hear it, but your vote in that system does not matter. Your vote with your capital has much more leverage than any vote that you could put in the ballot box for the president of the United States.
Yeah, the change is going to be emergent, just like money emerges in a free market. Dylan, what you said really resonates because I've had this thought from an investment opportunity. I don't have the time, but I think somebody should do this and it will happen. And they do this. Landry's is a good example. I think he's a partial owner in the Houston Rockets. Marty, if you remember his name, because I know he's I think he's a Bitcoiner. But what he did was he was in restaurants for a while, and he found this part of the market that was inefficient in the sense that he understood people that run restaurants are generally, they really like food and they like the hospitality, but they don't run a company in the most efficient way. And so long story short, he basically aggregated, he was buying up restaurants and then he centralized the point of operations, back office into a central point. I think it was in Houston to really just increase margin and operational efficiency. And he runs one of the largest Landry's food kind of conglomerates or whatever. I think he's a billionaire. The point being is I think there's something interesting to be done just in helping blue collar work, whether it's electricians, plumbers in certain localities or markets to be able to aggregate and then help them get on a Bitcoin standard or at least start to accept Bitcoin, understand Bitcoin. Because at the end of the day, when we go to the most micro level, the individual, just a single plumber or the restaurant individual that accepts a unit of currency that increases in purchasing power is going to have an unfair advantage by definition than the person that doesn't, that's holding the dollar. And when that person increases its purchasing power, it can increase its, marketability, the products and services it can offer, and ultimately the good or the societal impact it can give back to its close network, its town, the people around it. And that starts to build up into, and I know Marty talked a lot about the strong towns. I've never read it, but I would imagine it talks a lot about you have to start there before change can really happen. And that's where we talk about this. And I think it's so important from a business perspective for folks to at least start to hold a little bit, because you start to see that. And it really is the ultimate unfair advantage, because year over year, if you're able to withstand the volatility, size it correctly, over time, you get this freedom to do the things that you need to do, whether it's personally or for your business to expand versus be on this hamster wheel where you're going backwards, like the guy that took the home equity line of credit and now he can't even pay for the repair versus having a form of currency that he can take care of that and also expand whatever he's doing. So yeah, I think I think most people on this on this pod, but like I've never voted in my life. I've never thought anything I could ever do personally would ever change, even from a, like equities and stuff. I had Google stock. I sold it the second it would vest. I never have held an equity outside of that. It's just like, it was never trust that I was going to give my money to somebody else and then they were going to give me some more back. And I think that's felt more and more over time.
Agreed on the voting standpoint. I mean, I haven't registered to vote either. Only been through one election cycle where I have been able to, but I'm not gonna register again. I am a supporter of RFK's potential ability to shift the Overton window. I like people I think are missing the forest for the trees again. They're like, no, he's never gonna win, or no, imagine if he did buy Bitcoin, it would crash and it would crash the dollar and all of these blah 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 blah. And it's like, guys, like he has plus 1,400 odds, and I would say I think maybe they're a bit higher, maybe not. And Joe Biden can't speak a word. He's over there in Congress, on both the right and the left, getting an applause for his ability to just have a compassionate conversation. And he's saying, hey, I think we should lift capital gains on Bitcoin to, give some privacy back to, Americans with their transactions and to attract foreign intellectual capital to U.S. shores. And, oh, yeah, let's, passively just back, maybe 1%, less than 1% of new debt issuance with, hard currencies. We'll say, Bitcoin, gold, silver, platinum, whatever, appease the boomers with the metals, but like, how is that a bad thing? I think from a Bitcoin standpoint, when you understand what he's doing, he's obviously gunning for the Bitcoin crypto vote, but like, is that a bad thing whatsoever? From a Bitcoin standpoint? No, it's not. It's actually a really great thing. And I think maybe it's not front and center this presidential election. Next one, it will be 100%. And I'm really curious to see if it'll be a, right or left that embraces it. Like, imagine if RFK and Trump had a debate. I mean, I doubt RFK makes it out of the DNC, but imagine. And Trump's like, the nationalist dollar supporter, and RFK is saying, Bitcoin, this is, imagine they had a debate on monetary policy. Like, imagine that. Like, that's what shifting the Overton window does, right? Like, I think that's where it's a bit exciting, right? However unrealistic it may be. Like, people are, again, missing the point here. We have a presidential candidate, third in the polls, polling better than Biden, whether he gets a shot or not, saying, let's put Bitcoin on the Treasury balance sheet. And people are up there on spaces like debating the legal framework and stuff. It's like, guys, you're just totally missing. Like, it's like, it doesn't even, what do you, like, you totally miss the point of what this means.
I completely agree. I think a shifting of the Overton window, even if it's done by a presidential, actually, especially if it's done by a presidential candidate, is massive for Bitcoin. Forces people to talk about it, to think about it. And I'm all for pushing that window closer and closer to our worldview.
Yeah. And I think it forces every would-be presidential candidate to watch how this is going and see like, oh, wow, he's getting a lot of traction, a lot of attention, a lot of support just because he's pandering to the Bitcoiners. So it gives them this incentive 4 years down the road or 2 or 6 or 8 for, whatever elections, for other politicians to try to adopt a similar strategy. And then it's part of the mainstream. So Marty, you wrote about how Bitcoin wins from the margins. And this is how that process goes. You start with a more extreme political candidate, and then the success of that gambit induces the more mainstream candidates to adopt that strategy in the future.
Yeah, and you're already seeing, I mean, with the Bitcoin conference, I'm pretty sure, like, Vivek Ramaswamy, who's been rising in the polls on the Republican side, he was very supportive of Bitcoin, and I think that forced DeSantis to come out and support. Obviously, he was very vocally against central bank digital currencies, but he's had to at least pay some lip service to Bitcoin, whether or not he would allow it to flourish if he becomes president. So yeah, I completely agree. Like, just forcing people to talk about this, and it will be very interesting in the heat of the 2024 election. We're going to have a halving. There's going to be another Bitcoin conference right in the lead up to November, a few months before people actually go to vote. And I think the conversation around Bitcoin if we think it's pretty substantial now. I don't even think we can imagine how front and center it will be, especially if there's some economic turmoil that's going on at the same time as well. I think the conditions from a narrative perspective are lining up very much in Bitcoin's favor over the next year and a half.
Absolutely.
Like just the narrative of like FOMC press conferences, and like it's always fun on days where like it's not like 100% locked in what they're gonna do. Like some days the market essentially or Powell through their signaling and Fed speak kind of say what they're gonna do before, but sometimes it's like, oh, is the Fed gonna cut? Is the Fed gonna hold? Is the Fed gonna pause? And it's like, who knows? Or like it's like a Sunday night press release for some intervention or some like emergency rate cut or whatever, versus like Bitcoin programmatic, next block, halving, right? And it's like, oh, it's going to be like mid-April, and as it gets closer and closer and closer, and we see what the difficulty is and what hash rate does, that time gets more and more and more precise, and then all of a sudden, inevitable, no matter what you say, no matter what you do, it halves. And like we obviously all understand that function, right? Like for Bitcoiners, but for like the majority of people, like just like I was in COVID, they're printing a bunch of money, and then it's like, wait, this thing, what do you mean halved? Like the supply halved? Oh no, the inflation rate halved, the issuance? Oh, like that's interesting. And it was more just like kind of the people interested in finance and economics that paid attention. But like, yeah, imagine if it's RFK or Vivek or whatever, who's like rising and probably outpaces DeSantis at some point. He's a pretty reasonable candidate, talking about Bitcoin and its merits and sound money, while boom, halves, while Jerome Powell and the Fed cut rates and say that BTFP is gonna, because look at BTFP, the 1 year, right? That was late March, late March 2023, right? So if they're gonna renew that, or they're gonna let 100+ billion worth of bonds, marked at a par value collateral roll off, or are they gonna extend that right at the time of the Bitcoin halving, right? So like, yeah, I think like the halving is, people, including Jesse, your post, and maybe we shift to this after this combo, the stock to flow thing, like. The supply side of it is the main topic of discussion, but oftentimes, and maybe this is a bit contrary to like the typical view, is that I think that the halving is also a demand driver, because it like reinforces people's understanding, or maybe lack thereof, changes that understanding of like what it actually is. Like the programmatic monetary policy, not everybody understands that. People don't know what a Bitcoin block is, or 210,000 blocks until a halving. Like nobody really knows what that is. They don't really, Bitcoin's just kind of this, thing that trades and has a price, but it's like, oh wait, it halved. What is that? What are the implications there? Meanwhile, the Fed balance sheet is off to all-time highs or whatever. And like, even if it's just the Wall Street types that understand it, or some, some chunk of the political discourse that gets orange pilled because of it. With each halving, more and more people understand it, and it becomes more and more of a global event. And the Bitcoiners are partying, but like it's going to dominate the headlines that day. Bitcoin halving, nobody can stop it, nobody can change it. Next one, 2028. It's like, whoa, that's powerful. So I think that from a demand driver, the halving will also be pretty damn significant.
Guys, I haven't been this bullish for about Bitcoin in a very long time. It's kind of crazy to think about. Like you guys just jogging all the like the lexicon and the just like establishment talking about Bitcoin is kind of crazy. It made me think maybe you talk about at the margins is like Senator Lummis was like patient zero in there, and everybody's they see like the response, and they're all trying to pander to that crowd. And then the halving 2020 seems like so long ago that we're so long, and then also short that we're going to be right at 4 years again. And the stage is like set, and the awareness is orders of magnitude larger. And against the backdrop Dylan just shared, I can't imagine a more exciting time. And then we're all building in this space and contributing that we get to just front run it a little bit ahead of what's happening, along with BlackRock. I think BlackRock's trying to front run it as well.
Like think about what happened since the last halving though, right? We had MicroStrategy come out and say, we're adopting a Bitcoin standard. We're gonna sell shares, buy Bitcoin. We're gonna issue debt, buy Bitcoin. This is our reserve asset. We're not selling it. We're gonna post it as collateral, borrow more money, buy Bitcoin. You got 20 public miners that are trading with Bitcoin on their balance sheet that access credit lines and whatever else. You have El Salvador come out. Oh, it's only a small nation. Okay, that is established. Bitcoin's legal tender Lightning Network, Bitcoin, we're going to DCA, one Bitcoin a day, right? It's a nation that's small, whatever, but it's a precedent, right? It's a nation saying, you know what, IMF, we don't need your financing, giving them the middle finger and saying, we're going to buy Bitcoin. Now we have, only the third leading presidential candidate say, I'm going to eliminate cap gains taxes and put Bitcoin on the balance sheet. And people are like, oh no, he has no chance. And it's like, do you see what's happening directionally? Like only BlackRock said the ETF is, Bitcoin ETF, like wake up. This is the trend. And Bitcoin on a log scale is going up only, and people are still just missing the whole point of this. Like, haha, it's down 56% from all-time highs. And it's like, man, I can't really help you because you can't help yourself.
It's only BlackRock, Dylan. I don't know what there is to be so excited about. It's only the largest capital allocator in the world.
Well, and then, we talked about it last week, but I've never been more bullish on the technical side of Bitcoin, like how strong the protocol is, all of the upgrades that have happened since the last halving with Taproot, and particularly in the maturation of the Lightning Network. Like I recorded an episode of TFTC with Cody Lowe, who's the head of developer relations at Fedi. And AI, to an extent, it is a meme, but to another extent, there is a lot of fundamental value there. And it is becoming abundantly clear that for AI to be, we described this last week, but for AI to be as capital efficient as possible, they are going to have to integrate Lightning gated API access. And again, the tooling around the Lightning Network with the different implementations and the different wallet development kits that are out there, like it has reached a point of maturation over the last 4 years where it can actually begin to be implemented broadly in different sectors of the economy. I happen to think that the AI industry will be a massive first mover, but we're going to have that arrow in our quiver as well around the next halving. It's like, yeah, you can actually implement the payments layer of Bitcoin rather easily now too.
Yeah, that's a great point. Like the programmatic money, whether it's for AI or just the internet, while the price appreciates and awareness grows from a technological perspective and engineers and some of the best talent looking at this, and then it being able to be engineered via, the internet and AI, and just like we talked about, like some of the investments, like or companies like Wavelake or different firms that have a native unit embedded in their tech stack, that is going to be an insane demand driver from 2024 to 2028. I think Arthur Hayes had the piece about AI, but I think there's just like one component. Once people wake up to it and the price is a function of the awareness, that's something that we don't even talk about enough of the amount of demand that's just on the supply as it gets embedded into the tech stack of the internet.
Exactly. And it's funny how like Jack Dorsey nailed this, where he said that this is the native currency of the internet. And you think you understand all that means on the surface, like, oh, okay, there's a currency that you can use on the internet. But it's a really deep meme because it really talks about how all of these systems, whether that's AI or businesses or whatever, you can create this functionality and transactional ability that you can't with conventional currencies using this currency. So adoption starts to shift towards this thing where you can do something that you can't do with any other currency. And that's just tailwind. That's a tailwind over time, over decades. We think of the internet as being fully built out already. Like the internet has happened. It's reached its final state. That's not true. We're still in the middle of the internet revolution. And, the Bitcoin becoming the value unit that the internet can build on is kind of the second half of this internet revolution overall. So that's just one of the tailwinds, as is the mainstreamification of the Overton window and Bitcoin. At the same time that we're going to have, I think, massive stimulus to get us out of whatever financial crisis happens over the next 12 months because of interest rates getting jacked up and being held there, and the body showing up over the coming months. And all of those things converge at the same time, such that there's tailwinds that we've never had with Bitcoin before, going into a halving. So I think there's a case for, and I've written about this, that next cycle could be bigger. It may not be, but I think there's a better case for this next cycle being bigger than for any previous cycle. So
are you saying that on the other side of the next halving, the debate over stock to flow is that it was too bearish?
Yeah, in terms of stock to flow, who knows? I think that's the reality with stock to flow. Who knows? I guess that's my cue to get into that stuff, huh? So, all right, let's talk about stock to flow, because
we call a natural segue in the biz. Okay.
Yeah, made a bit of a splash by standing up for the idea. So just to describe my thoughts on this, and I'll try to pack it in. To start, stock to flow, the stock to flow model is specifically wrong and directionally correct. And what does that mean? Well, okay, what we're actually talking about, we have to disentangle it a bit. The stock to flow model has become three things. That we think of as together. It's the man, it's plan B, the person who created it. It's the stock to flow model with uppercase letters, the specific price model with specific price targets. And then there's the idea of stock to flow, lowercase stock to flow, that a commodity that has a higher stock to flow ratio, meaning lower annual issuance relative to the existing stock, and ends up becoming more valuable because it's a better store of value. Those are three different things, and we jumble them all together, and we throw out the baby with the bathwater, I think, because people take issue with the man, Plan B's behavior over the last few years, how he's handled critics. The optics haven't been great. And so people are salty about that. The model has flaws. It's an attempt to take a data set and explain what a trend that appears to be happening. That's what a model is. And that and that has pissed people off, and especially pissed off statisticians, mathematicians who take issue with the specifics about the model that aren't statistically valid from their point of view. And I actually totally will concede that. I think we have to be prepared to toss out the model, the specific price model. I do think that there's some valid. One of the major complaints about it is that you can't have a time-based correlation. You can't just track with time. Value appreciation can't be linked to time, because how is that statistically valid? But Bitcoin is time. The halvings are time. The increasing scarcity that comes from the halvings, that's time-based. And so I think there's some issues there in terms of statisticians not really seeing how stock to flow as a concept kind of sits outside of the normal correlations that they're looking at between two variables. But okay, fine, we'll toss out the model. There shouldn't have been specific numbers about it, because those numbers got turned into promises, and those promises were broken, and people are angry about it. There should never have been specific numbers in my book. So fine, the man has made his missteps, the model has its flaws, and we should discount it as a valid model. Yep. But what about the idea? So the idea of stock to flow is just this observation that when you line up, on a plot, graph the different commodities with their stock to flow against their total valuation of the existing supply, there is an upward and to the right trend. And there's some noise in there, sure. But there's a trend of the less annual issuance there is, the more value is stored in that asset. So gold has a high stock to flow. And this is what Saifedean includes in the Bitcoin standard. kind of the whole first third of the book is about how gold won as a commodity money because it had the highest stock to flow compared to any of the other options. So it became the best, most reliable store of value. That's why it won. That's stock to flow as a concept, as an idea. And so that's what I'm trying to advocate for in my writing about this, my article about why the stock to flow model is specifically wrong, but directionally correct. And I think that it's time to swing the pendulum back a little bit to appreciate the potential merits and discuss the potential merits of the concept as an idea. And we can toss out the model in its specificity entirely. I'm fine with that. And I think it's time to bring that discussion back into what's allowed in Bitcoin, because this is a taboo topic that you're not supposed to talk about for some reason, because the people who browbeat everyone on how this isn't statistically valid seem to be proven right in the bear market. And now that the price has kind of rebounded a little bit, we're sort of going sideways towards the next halving. The same mechanics could play out again. This idea at a conceptual level seems to be tracking decently. So let's talk about it. Yeah.
I mean, I'll go left side of the bell curve here. There's only 21 million Bitcoin. Everybody's going to need it. Number will go up. Stock to flow. Like, it's pretty simple.
I mean, I call it correctly. I see like regression theory and all this crazy shit people are saying on Twitter. It's like there's a certain amount of stock and the flow gets cut in half every 4 years. If you have all the monetary properties, you can't change that, but you would think it would go up. It's like the thesis. When initially all the Plan B stuff happened, like I never understood why everybody was so angry with him. I understand like getting mad at like Mashinsky or like certain people that are like naturally defrauding people, but it's a fucking model. Like if he made a price quote, it's the same as like Michael Saylor taking leverage. Is that the prudent thing to do? Who fucking knows? But like you get to decide to do it. You get to decide if you're going to allocate based on a model, not a veteran industry. It's really insane. I know, Dylan, you might have to run in a bit. So do you want to share some thoughts on this before you do?
Yeah, no, I mean, I'm gonna be honest. Like I was in high school, stumbled upon Bitcoin. My cousin was in the ICO boom. I didn't participate at all. I mean, I didn't have any money, but I'm looking at finance and kind of trying to learn my way around things. I know crypto and don't immediately dismiss it because I don't know any better. Kind of stumble upon Bitcoin on Twitter, like find the right side of crypto Twitter, like the Bitcoiners, and then. My 18th birthday comes and boom, like within, I don't know, a couple weeks before or after, Plan B launches that model. And I'm a math guy. Like I didn't really understand much about Bitcoin at that point, but like made sense to me, like from a math perspective. I was like in calculus class, ignoring the work I'm supposed to be doing, looking at this thing, being like, wait, what causes that? And it just, forced me to like go down a rabbit hole of having difficulty adjustment, understand like the protocol at a deeper level. So like, no, I mean, it's just a model. People are like, no, it's gospel, or like, think it's like, heresy. Like, I don't think it's either. I just think it's, it was a cool thing to like conceptualize Bitcoin's scarcity, Bitcoin's, supply issuance, its monetary policy. It will fail eventually. I mean, if it hasn't already technically failed now, but like, I mean, it's a great thing to understand. Like people oftentimes will just like look at Bitcoin, search Bitcoin, or look at like Robinhood, and it's like a chart, and it's just like bubble crash, and they're like, oh, whatever that thing is. But like if you understand math, like in the, at the not a basic level, but a little bit more than the most basic level, and you look at a log scale Bitcoin chart, and then when it halves, you're like, whoa, this is maybe there's something here. Yeah. So again, like I think the debate is blown out of proportion. People are calling Plan B like names and going back and forth. It's, I don't really even care to get into that, but I think it's cool. It helped orange pill me, right or wrong. So, I think it's cool. I'm thankful for that, him publishing it.
Yeah, it's greatly spurred my thinking. I think a lot of my work over the last 3 years has been around trying to like pressure test the stock to flow concept, just the idea. And, I write about increasing scarcity. And I think that is the engine for Bitcoin's growth. Dylan, you mentioned this earlier, that like the halvings are a supply side event, but they also spur demand, increase demand. And that's very interesting because from Bitcoin's point of view, like to anthropomorphize Bitcoin, how does it induce adoption? It can't control demand, but it can control its own supply schedule. So it has this function of, okay, well, I'm going to, you've got your supply line and your demand line, and they meet, right? The Marshall cross, and price is set where they meet. But you can move the supply line, and that's the halving. The halving is this prime mover, to jokingly refer to the religious connotation, the prime mover of adoption, because it creates the supply shock, changes that Marshall cross, that one line gets bumped in a direction that causes the price to have to rise. And that whole cycle creates, a speculative bubble that brings in an incremental slice of the adoption curve. Some of them get washed out because they speculate and don't understand. Some do their homework and become sat stackers. That's what we've lived through for 14 years. So increasing scarcity to me is the beauty of Bitcoin. It's the adoption engine for Bitcoin. And that's fundamentally a stock to flow related concept. So I think it greatly spurred my thinking. And, if you're excited for the halving, like who's excited for the halving? I'm excited for the halving. Why are we excited for the halving? Because there's reduced issuance at that point in time. There's increasing scarcity. The stock to flow number is going to go up at that point in time. That's why we're all excited for the halving. And so if you're excited for the halving, you are in a way a believer of the stock to flow idea, not the model, just the idea.
Well, as a Bitcoin miner, I wouldn't say I'm particularly excited for the halving, but
fair.
I think I'm well positioned to survive the initial. And I do think, completely agree, because I think I do understand what you're trying to say, Jesse, but I do think we have to be very particular with language. Like, there is not a supply shock. There's a supply inflation shock, right? Like, there will,
yes,
like, you're not reducing the amount of Bitcoin, you're reducing the amount of issuance. And that's where I think, actually, what I think the critics of stock to flow, and particularly Plan B's model, they really lean into, like, you can't predict demand. It's like, yeah, obviously you can't predict demand. It's going to be volatile in the short to medium term, but over the long run, you can be pretty certain, due to the properties that Bitcoin has as an asset, and then the properties it has as a network, like, there's going to be increasing demand because it has fundamental utility as a store of value asset, and then as a distributed network that can act as a native payments layer of the internet. And so unless you're living under a rock and not able to think multi-decades into the future, like the critics saying you can't predict demand are, I would put forth, either stupid or disingenuous, where it's like, yeah, obviously you can't predict demand, like, in a particular month, day, week, year even, but if you understand what's going on here, you can essentially predict out that, yes, there's going to be significant demand for Bitcoin because of the utility it provides in many different ways.
You just hit the nail on the head. I was trying to rationalize or understand where the like animosity comes from something like this. And it's not actually an intellectual thing. It's an emotional thing, that anybody that actually thought initially that stock to flow was the price, they show it through the emotions that they're pissed off that somebody's looking at it. Because anybody that I know, like, we talk about Safe, and there's other people within our friend group that, like, saw it's like, oh, that's interesting, but they never subscribed or, like, thought, oh, the price is going to hit this number. It's like, that's something. But you could see how somebody would be very annoyed or angry if they initially looked at that and either made a, like, personal economic calculation or tied to it. So it's just like a thought that came into my mind when you reference, like, where somebody would be upset. But Dylan hit on a key point, and this is where, like, I'm most appreciative of Jesse, like, what you put out and just some of the content you do. It's like, part of this show, the realization is we've been in this bubble, and I was thinking about this the other day. Like, we've been looking at Bitcoin 5, but I don't even know, Marty, 8 years. Like, you just look at this stuff, and your whole kind of, like, mind starts to shift on how you look at the asset, other assets. You know, we shit on 401ks and bonds and everything else on the show. But it's just like, so we forget what traditional finance and individuals, how they're approaching the space, the frameworks they're using to look at it. And so, like, as Dylan described, it's just like a framework to look at it. And there's a certain amount of stock, there's a certain amount of supply, it changes, price may go up. Interesting, I should pay more attention. That's as simple as it is. And like we look at like over time, the new vintages of Bitcoiners, whether it comes in this year, next year, in subsequent years, the content needs to get resurfaced to the good content, the right framework, because it's important. Like if it's by definition good, then it's evergreen in this ecosystem, and it's going to be important to like bring. And I think that's what Jesse was attempting to do. And it's actually like, in my mind, and you can share if you want, just it's like you almost like everybody like fell into the trap. Like you put it out there, it's on purpose. Like you don't believe in the exact number targets, but it's like, hey, we should talk about this. And instead of realizing, it's like everyone up in arms, and it's like you fell in the trap. And now we're sitting here and everybody's talking about exactly what he wrote about. So.
Hey guys, I gotta run here, but it was a hell of a rip. Excited to see this one published. Don't really have anything else on my end, but it was fun, and let's do it again.
Yeah, Dylan's always awesome having you on. We'll do it again.
Yeah.
Cheers, guys.
Keep crushing it, dude.
Thanks.
Jesse, did you set a trap intentionally?
Not really. I knew that it would trigger some people. I knew that it would trigger all the stock to flow haters.
That's a trap.
I actually think that at some point in time, this becomes a non-taboo topic again. And I think a part of that process is disentangling the whatever perceived sins Plan B committed from the idea of stock to flow as it was laid out in Saifedean's book. And, you know, I think that how this could play out is the halvings keep happening and price keeps drifting up in the 12 to 18 months following the halvings and establishes a new price equilibrium in that 4-year era. And it happens again, and it happens again. And at some point that pattern is pretty hard to deny, right? Like the halving seems to move something, whether it's purely psychological because the impact of the reducing block reward size change, that gets smaller, but it still triggers some psychological behavior in the populace. Fine, maybe that's part of it. But I think that, I think the mechanics of the halving, increasing scarcity, will continue to cause some bull markets post halving and then seeking an equilibrium for the rest of that halving era. And that is the stock to flow idea. So at some point that has to re-enter what we're allowed to talk about by whoever is policing the narrative. And I decided to, since stock to flow has been so important in my education and journey in terms of building my conviction and stimulating my thought about like how do these mechanics work. I have a whole thread on what happens with the supply, how the supply shock manifests for new supply issuance, and how that eats through available for sale supply in the 12 months following the halving, and how those mechanics drive a bull market. That came from me trying to understand this stock to flow mechanics at the halving and how that plays out. So it was important. It's been important for me. I think it's a key part of deeply understanding why this thing is the best savings technology ever, because it has this unique property of an increasing scarcity that no other asset out there can match. And so we have to appreciate increasing scarcity and the fact that delivers value appreciation over time. And that means talking about stock to flow as an idea, not as a model, not trying to put the man or the model on a pedestal, but bring that idea back into the conversation.
Yeah. Again, I'm going to grab my caveman club and just say number of Bitcoin produced per block go down, demand go up, number go up. It's pretty goddamn simple. people kvetching over this. They're annoying.
Yeah, and actually, that's sort of one of the arguments against stock to flow is like, don't think about it. Just think about 21 million and think about the absolute scarcity at the end of this increasing scarcity sequence, which is the easiest thing to think about and a totally valid thing to do. But the reason I think this is the fastest horse is because it has this increasing scarcity on the way to that terminal absolute scarcity. And that's exciting. So let's talk about it.
Yeah. Yeah. And again, it's just all semantics. Like you can never predict demand in the short to medium term. But again, going back to what I said earlier, like if you understand what's going on here on the asset side and on the network side, it's pretty obvious that nothing can do what Bitcoin can do in both regards. And that is going to drive demand over the long run.
It's actually, it's funny, like we talk about the difficulty adjustment being like a beautiful feature, right? Or like absolutely necessary. But like the thing it's in the narrative, but we don't fully like grasp, and I don't know when we will, if we ever, is like the supply shock of every 4 years and why it was programmatically set up, and in the 50% reduction, like in the flow of like awareness and the dollar, appreciation, and then how it goes back. Like, I think that obviously has like, if it didn't exist, what does that like demand and awareness look like? And do we end up as success? I don't know, but I know it's been discussed, but I don't think there's enough understanding. I don't know if you guys like have thoughts, or if it's even like, pointing anybody, including myself, in a direction of like that being discussed, of the supply shock every 4 years of 50%, and how that just, sends it out into the awareness via price function, comes back, and then does it every 4 years, is how that was necessary versus anything, any alternative.
Yeah.
Yeah. I think it's the marketing department for Bitcoin is that. Otherwise, if it was a smooth scale, smooth issuance schedule, then there's no moment in time to talk about it, to think about it, to have something jarring happen. So I think that it was it may be unintentional, but genius inclusion in the issuance schedule.
I don't know if it. I mean, it had to be intentional in my mind.
Yeah, of course.
And I think Satoshi actually touched on it. Like it was like you start at 50 Bitcoin and you cut it in half at 210,000 blocks because you need a way to distribute the supply and a lot of it in the bootstrapping phase to incentivize people to plug in their miners.
Right. And you incentivize them earlier adopters too. Like that's the promise for the very earliest cohort of like, get your supply now because it gets way more scarce in 4 years. Like that's the marketing department for Bitcoin.
And it was his way to dispel, or their way to dispel efficient market hypothesis. It's like, remember 19?
The halving's already priced in. It's already priced in, guys.
It's priced in. People in 2023, it's the same thing. It's like 23 million people priced in.
That's part of the hate for, it's weird because there's this coalition of people with various reasons for hating the stock to flow model. The bulk of them are people who put too much stock in that model and bet on it, right? Like they 100x longed, because we're going to 100K. So they got burned and they're pissed. That's a huge portion. Then there's the like statisticians who find issue with the specific model. Okay, yeah. They're a small and very vocal group, and they've got great receipts, because it's hard to argue with that. And I don't argue with it. Like ultimately, the flaws in the model are real. There's the time-based thing that I take some issue with, and then there's the EMH people who are coming from traditional markets who think it's not possible for the halving to matter because it is known information in advance. So therefore, it must be priced in. That's the efficient market hypothesis. And Bitcoin's entire 14-year history flies in the face of the efficient market hypothesis. Because why has it appreciated over time? Why didn't it instantly go to $30,000 per coin? Because you saw the issuance schedule ahead, so why didn't you price it in? That's not how it has played out.
I mean, it hasn't played out like that in any market. Like, the housing.
Right. But they still teach you.
Market should have been priced like correctly in 2007. Yeah. That was the case.
At Stanford Business School, they teach you the weak form efficient market hypothesis. And at the time, I was like, this doesn't seem right. Like, how do you get an edge in a market? Yeah. But that's what they teach you.
Yeah, this is the insanity of the fiat world. We're coming up on almost 2 hours here, but I do think if you guys are open to it, touching on the other controversy that you were thrust into yesterday, because I do think it's a good teaching opportunity to really help listeners that are coming in and learning about Bitcoin and have the question of why Bitcoin, not crypto, to really show the perverse incentives that exist in the crypto market. And so, Jesse, well, I'll find the tweet. You can explain it, and then we'll watch the video.
Yeah. So I came across a video of Meltem, or however you say her name.
Meltem.
To her credit, she, I think, was explaining why there needs to be regulatory intervention in the crypto VC space as it exists. However, she's kind of roughly in that world. She's an angel investor in crypto things. She may not directly work for a fund, but that's part of her world. And she's explaining the game. She does a great job of articulating the game that crypto VCs are playing at the expense of retail investors. Well, we got the video playing.
Doug, we're hearing nothing on our end. Give us a sec. And yeah.
What is the exit event? A lot of the venture capital that has come into crypto more broadly as an asset class has come because there is liquidity in investing in tokens. And we can ignore it, we can pretend it doesn't exist, but incentives drive behavior. And I think one of the big incentives we've seen play out in the crypto venture space, 35 billion in LP capital last year went into funds. Why did that capital go into a lot of these funds? Because they're able to deliver cash back to their LPs by investing in new L1s, L2s, dApps, things that have a token that enable this faster turn on getting an exit event, a liquidity event. And that's where the challenge really is for the Bitcoin space. So that's why I'm excited that we have ordinals, we have BRC20s, because they actually start to maybe enable us to generate new streams of revenue. What is that?
Yeah. Marty, how does that make you feel?
I want to preface this with like, again, I think you described it well. Melton's just describing the game, but I do think there are some misguided notions that BRC20 tokens and ordinals coming to Bitcoin will be additive to Bitcoin because there's going to be these quick liquidity events that are possible in the Bitcoin ecosystem. Like, I don't think anything in the Ethereum ecosystem, Solana, the ERC20 world, or the NFT world has really proven to have any long-staying value. It's all, in my opinion, a product of late-stage fiat, people speculating to make a quick buck. And the nefarious thing here is that it's institutional capital, knowing that they're dumping on retail, making insane gains, good for them, returning capital to LPs. As a venture capitalist myself, like, that is the goal, and they are succeeding in that goal. But yeah, this gets into like the gray area of ethics and morality, and whether or not this is something that should be normalized and we should be championing on Bitcoin. Right. And I'll make it clear, like, I don't think, in my opinion, I don't think ordinals and BRC20 tokens really have long-staying power. I think they will pump. I think there will be a lot of fervor around them this next cycle. But at the end of the day, I think Bitcoin as a monetary asset and a payments like layered protocol is going to be the killer app, and we don't need any of that stuff. And it's really catered towards very niche markets that is very clout chasey to me, all that stuff.
What you're describing is what Dylan was describing earlier about getting out on the risk curve. I I'm glad you brought this up, not to the sense to say anything bad about anybody, but more to drive awareness that over these cycles, we see consistent narratives change, and we see like altcoins continue. We saw the ICO buzz, STOs, DeFi. And when the price kind of like, we talk about these halvings, when the price goes out, then like all of the activity dries up because it's all speculative. And you pump the bags, you get the institutional capital in, you dump on retail, it's rinse and repeat, but you have to change the narrative over time to continue to like go, because over time people will catch on. And so you see, part of this is like going and it's basically affinity scamming. We've seen it for the past 13 years in Bitcoin, where it's the BRC20 and all these other, acronyms. And I think it's just important to discuss here to people as they go. It's like, okay, I understand the Bitcoin signal, but now there's interesting things happening on Bitcoin, and I can get a higher appreciation or return on my personal portfolio or whatever if I buy this token versus just the underlying. But the reality is you just need a native unit. They're all competing with money. Bitcoin is the best form of money, and that's why you just want to hold the underlying and not engage in any of this like crazy stuff. So if we can help anybody in doing that, whether it's via this show or reaching out directly, that's what our goal is, not only to get you to hold Bitcoin, but not to buy all this other crazy shit.
Yeah, and to make the other crazy shit a little more explicit, Melton on Pomp's podcast describes the shitcoin waterfall, the mechanics of it. Of you've got your when a coin is launching, you start with your pre-sale, and it's ultra insiders. It's all the big money in crypto who have had success backing projects. And you get them in a room and you say, we're going to give you a portion of the supply at this price. And they're like, okay, we're in. And then they hype it up to the next layer of the onion, the not quite as insiders. So then you do your pre-sale and you charge them 10x the price. So suddenly the ultra insiders have already made a 10x profit unrealized, but great, everybody's happy. Then you go to the next layer and you do your sale and charge 10x the price there. So the ultra insiders have made 100x, then 10x, then you get these new people coming in. And then you go to retail and set the price high. Everybody who's participated so far as an insider hypes it up, talks about how it's the next big thing. It's going to change the world. You're going to kill yourself if you miss out. And that's them exiting. That's them selling their cut to retail when it finally hits the market after all this hype has built up. And that's a 12 to 18 month process, rinse and repeat. Retail gets fleeced.
Yeah, and I mean, I'm just going to name names like Novo during Terra Luna. Like he has a Terra Luna tattoo, which he marketed and showed off on Twitter like a couple weeks before Terra Luna officially blew up around all-time highs. It quickly went to zero after reaching all-time highs. And apparently word on the street is he only gets a tattoo when he books $1 billion on the trade. So he'd already like booked that trade, pumped it to the markets, and yeah.
And it's, I appreciate like Marty, when you get a little Marty Jones on like these people or like the situation, because when you really boils down like what Jesse just described, we talked about earlier, like the guy that was a bagger that's like, oh, I can't mess with this stuff because it's kind of crazy. It's like, imagine if the lens was, oh, this is how I can increase like my purchasing power, or like my life will be better off if I just have this. But he doesn't understand that because of everything that Jesse just described and what we're talking about, and what, altcoins and just like this kind of like risk curve. It basically turned into the Robin Hood-ification of like, maybe I buy it, maybe it ends up zero. So there's just so much like noise out there. And so it does have to be like called out, and there has to be like, I don't know, there has to be a recognition and continue to like explain it, because it really like hurts a lot of people and damages, whether, think about how many people are holding zeros because of FTX, BlockFi, Celsius, and the list goes on. And will continue to go on because it's just information asymmetry, and this stuff is new. And so there's people out there to continue to sell basically snake oil.
Yeah, and I've reached a point in my 10 years of being in this market and seeing many of these cycles where, I have actually been very ardent in calling this stuff out, calling them shit coins, saying that none of this will amount to anything. But for like the first 8 to 9 years, there was always that that small little doubts in the back of my mind, like maybe these shitcoiners are right. Maybe there is something here. But in the last 2 years, it's become abundantly clear that no, there will be nothing there. You don't need their tokenomic schemes. You don't need their blockchains. You don't need their functionalities to achieve the goals that Bitcoin has set out to achieve. And you can even make the argument that even if another token or project markets that it's not really trying to achieve the goals of Bitcoin, it's doing something completely different. If you do enough research and dig into the fundamentals of the problem they're trying to solve, they don't need a blockchain or a token at all. They're just trying to affinity scam, like Michael said, to use the new buzzwords and the new technology to bamboozle people into believing that it is the solution to the problem they're proclaiming to solve. And yeah, I've reached a point where I do think a lot of the people pushing these scams, particularly those that have been through many cycles, are reprehensible humans that should know better, yet for some reason or another refuse to stop scamming people. And they do need to get called out. And as a free market capitalist who really doesn't want the SEC or the federal government to come in and overregulate and throw the baby out with the bathwater with Bitcoin and lumping it in to all of crypto, like that is how you regulate, is social signaling and self-policing. And within this industry, that's something that Bitcoiners have been much more known for, is attempting to self-police and just being called salty individuals who are mad that other coins are outperforming Bitcoin within certain time frames. But no, it's like for me personally, I don't think I'm wrong. Could be wrong. My gut is telling me 100% right. Like, these people are scamming retail investors. They're getting insane profits, returning it to LPs. Good on you as a venture capitalist. But at the end of the day, these people have nothing to show for it except their returns and the ravages of the retail investors they burnt along the way. And it's something I will not support publicly, have never supported publicly, but will be more vocal in calling out moving forward.
Yeah. I think very well said. I think at the end of the day, this is like we're in the financial service business. When we think about like what we're doing, you mentioned on the venture side, or what we're doing at On-Ramp, and it's all built on trust. And it's something I recognized very early on at Unchained, when folks would come in, and I felt like kind of a little arrogant, or it was very bold to say, it's like, you found the signal here. If you just decide to stay or not, it's up to you. Because during the bull market, right, people are coming in and they're doing all this sorts of stuff. They're lending on BlockFi, they're going to Celsius. It's like, we want to help on like the journey, because we can help along like the years there of like, how do we looked at all this stuff and we can tell you like, this is the plot holes. And it's almost like a one-way hash function. It's like you hear it and you're like, oh, this actually makes sense, in the direction of like, oh, I understand it, where it was hard if you didn't know what you were looking at. And so even to the extent on our side, like on the On-Ramp, from an institutional family office individual, if you're looking at this and you're like curious, like I think there's something these guys are saying, but I would like to learn more. Like, you can come book a consultation, jump on a call, walk you through it. Because over the 3 years while we did this at Unchained, like from personal anecdotes, there was people that were able to save 500 plus BTC off of Genesis, BlockFi, paying off the loans, self-custody versus leaving on Celsius. Like there's real like effect if like taking action, whether it's via the pod, talking to other people, going on chain, going on ramp, other trusted parties, or not doing anything. Because the reality is like all these people are using individuals that have less knowledge as exit liquidity. And it doesn't have to be that. And that's part of like this whole show, is just like education and being able to share with other individuals so those mistakes don't happen. And over time, once it gets to a certain thing, like they're afraid to do it because you're going to get called out ahead of time. It's like, do I really? Right now, it's still there. We're like the intolerant minority, because crypto, if you're Bitcoin only, you're still, I think, closed-minded in most people's view. And then they'll whitewash history and be like, everybody was Bitcoin only. It was so obvious. The same way as everybody's gold only. It's not copper or aluminum. So we're in this weird period, and we're just going to continue to do the part. We're going to win, Marty. We're going to win, Jesse.
We're winning, guys. We're winning. I've never been more bullish in my life. Like, it's all there. We just got to keep trucking, keep going. Bitcoin is an idea whose time has come. Like even like piggybacking on that, people have been shitting on Lightning for 5 years. And I said this on a Rabbit Hole recap yesterday, but I think it's important to reiterate here is a lot of what you're seeing in terms of people going speculating in shitcoins, people shitting on Bitcoin for it being relatively slow, low transactions per second, and scaling in this layered fashion, which hasn't had immediate success, is driven by an impatience that has been normalized in the fiat economy. Right? We are building cathedrals here, as we said a couple weeks ago with Alex Leishman. Like, it takes time to build out Bitcoin at the protocol layer. It takes time to build out the Lightning Network from a liquidity and node topography perspective, and then from a tooling perspective. Like, it literally takes time to build out these cathedrals to the point where they have utility in the wider economy. And people who point at Bitcoin's volatility and say, oh, it can't be a store of value. It's like, do you really expect the best money that humans have ever come into contact with, that is a foreign concept to most, being a digital currency run on a distributed network, is going to monetize overnight? Like, your impatience is blinding you to the fact that this volatility should be expected. Similarly with Lightning, like, oh, it was launched in 2018. Why is it not embedded in everything, in every online company today? Like, number one, asymmetry of information. People simply don't understand Bitcoin, let alone the Lightning Network and how it interacts with the protocol layer. Number two, it literally takes time to build out the tools to enable people to build on Lightning. And that's what we're seeing. And that's why I'm so bullish right now, because I do think we have hit a tipping point in maturation, particularly for the Lightning Network, where the tooling is at a place where it's going to be a lot easier to implement this stuff into online services. Don't be impatient. People want, it's the fiat mindset. We want quick, bang, bang, bang. It's the quarterly mindset. Lower your time preference. I know it's cliche, but like, again, we're building cathedrals here. It is going to take time, and there are scammers out there who are going to take advantage of your relative impatience and say, hey, you don't like that with Bitcoin, you don't have that with Bitcoin, here's this token for you. It can do it. But at the end of the day, it doesn't have the fundamental base layer necessities, primitives to actually make it a potential long-term success. Because for these things to be successful in the long term, they need to have sufficient distribution of full nodes, sufficient distribution of hash power. They have to be proof of work chains, which people don't realize yet. They have to have distribution of private key ownership, and then fractal that up to other layers as well. It takes time, and people are trying to leverage your impatience to stack more Bitcoin themselves.
We need more Uncle Martys. If they don't take advantage of your relative, patience, they'll take advantage of your relatives. So you need to send them, if you're worried, send them to listen to the pod, send them to us. We will support and helping, because there's a lot of Bitcoiners that get this stuff, but there's a lot of people on the external side that are going to get the next wave. The halving comes, the price appreciates, and the next people are going to take advantage of them. And if we can get ahead of that, everybody's going to be better off.
Yes. I want to apologize for looking like a complete slob today. I had a bunch of calls this morning. I was not able to spruce up. I was not able to shave. I'm sweating right now. It went from a rainy day to a beautiful sunny day here over the course of the last 2 hours. But it was a great rip.
Yeah, it was great. You're fired up. That's all we can ask for.
How can you not be fired up, baby? We're changing the world. Let's go.
Yes.
Weekend at the shore. Ready to go. We'll see you next. You're coming back to Texas next week?
I'll be in Texas next week.
Yeah.
We'll be recording in person. Michael and I will, at least.
Nice.
Hopefully.
That'll be fun.
Yeah.
Yeah. Jesse will be here soon enough. It's nice. I was at Cooper's yesterday with Parker having lunch. Look back, your brother walks in. Oh, how's it going? Grill some steaks. Tomorrow we'll be back in town. Bitcoin capital of the world.
Living the Austin dream, but they're passing a housing ordinance to allow for smaller lots like San Francisco, based on San Francisco.
I don't think we should be tracking what San Francisco is doing. So
yep. People are celebrating it, and it's a little concerning.
All right. Something to be aware of. We'll see you guys next week. If you're liking the show, please subscribe. If you're listening on a podcast app, subscribe there. If you're listening on Fountain, Podcasting 2.0, and you're streaming us Bitcoin, leveraging the network side of Bitcoin to give us sats over the Lightning Network as you listen, thank you. If you're on YouTube, hit that subscribe button, hit the notifications, and share this. If you're an institutional investor, a high net worth individual, or just somebody who's looking to educate others about Bitcoin, please share the show with them. Like Michael said, we're really trying to help get ahead and prevent people from getting confused and bamboozled. Number one, to try to get you to realize why Bitcoin's important and why it's going to be extremely valuable in the future.
Absolutely. We'll do this every week.
Yes. And with that, I'm going to hit the beach.
Have a great weekend, guys.